We've got Jonathan Hunt, the MD and CEO, joining in right now on the show. Jonathan, hi, morning. Again, a guidance cut by you guys, and the major factor we understood which led to the slowdown in the US is biotech funding. Did the situation get worse in the third quarter as opposed to what was in the second quarter? And going forward, do you believe there's any scope for betterment?
Yeah, sure. Gosh, there's a lot in that question, many multiple parts. It would be wrong if I didn't start with saying we had a pretty solid quarter. We delivered 9% growth, and it actually turned out pretty much as we expected. A little bit more softness in the quarter than I'd hoped for, which is why we've adjusted the full year guidance. But it's not a different trend. It's just a little bit more of that trend. As you know, our business, you can simplistically put it into two halves: research services, development, manufacturing. And what we're seeing in the research services side, as our peers, our competitors, and the market in general, is there's just a slowdown in the rate of funding that's going into a part of that industry. So it's into the US biotech segment. They're very reliant on new capital formation, private equity and venture capital flows. And with interest rates going up, other bits of the economy opening up after the pandemic, there's just a bit of a slowdown in that sector. I don't think it's structural, doesn't look to be. I think it'll be temporal, which is a way of saying I think it'll work through. Now, we were actually hit a little bit later than many. We were quite resilient to it in the first half of the year. Hence the fact that the guidance adjustments have been concentrated in the second half of the year. Outlook, I don't know if any of us can call it with absolute precision, but it feels to me a couple of quarters, maybe three, something like that, and it should have worked its way through the system. Year over year comps will start to get better.
Right. Morning. I just wanted to get in a take from you as well, Jonathan, as to what the outlook is when it comes to your EBITDA margin guidance. 30% is what you had shared earlier. Are you going to be making any changes here as well?
With no change, around 30% EBITDA margin, plus or minus a little bit, it's not just where we are in the year, it's where we've been sustainably over multiple years. It's well above average for our industry group. We're one of the better margin structured businesses on a global basis. I see no reason to change that expectation either between now and the end of the year or over the long. For guidance for next year, we have a habit. We cover that at the full year results in April, which is where I'll give more precise guidance. But I tried in my comments to give you a bit of a sense. This is a temporal issue, I think, in US biotech. More broadly, the industry fundamentals are pretty good.
Sure. So given the challenging business environment, would you like to revise your Capex guidance for the full year at $80 million or no changes there, you think? And what would be your focus area going forward?
Yeah, well, of course, remember, once we decided to do the acquisition of the biologics plant from Stelis, and we did that in the quarter to bring new capacity online years earlier than our organic plan. Of course, that changed our Capex guidance. We'd started the year at 100 million Capex for the year. We adjusted that down because we did an acquisition rather than investing in internal Capex. Expectations for the full year around 60 million now, and 40 million of that has already gone in. So there's 20 million in flight that we should finish during the quarter. So good, we continue to invest in the business. We continue to invest to create value in the long term. And we continue to put in new science capabilities. We put some nice infrastructure into our R&D operations in Hyderabad. During the quarter, we brought online a new automated DMPK setup. We invested in compound management. So we're doing all the things you'd expect a sophisticated sort of technology-led business to do. And I see no reason, just because there's a couple of bumpy quarters in the market, to change our long-term investment plans, because we think that'll create value in the medium term.
All right, Jonathan, appreciate your time. Thank you for joining us.